economy performing well and expected to continue to do so, the committee judged that a modest increase in the federal funds rate target is now appropriate, recognizing that even after this increase, monetary policy remains accommodative.
The Federal Reserve has finally achieved policy liftoff, nudging the cost of overnight borrowing slightly higher, and markets are very happy. Global and US equities are rallying, led by financial stocks. Investors in general are relieved that the long drawn-out saga of will the Fed go or not has finally been settled. But how long will the good vibrations last? The positive reaction across markets reflects expectations that the first Fed tightening cycle in nearly a decade will be slow and steady. The Fed released its latest estimate of policy shifts in the coming years. For 2016, they expect just 4 rate hikes, which will lift the median back to 1.375% from its current 0.375, and then for 2017 they expect the funds rate will be at a median of 2.375. Is this a realistic outlook? In recent years, the Fed's own assessments for the economy, inflation and policy shifts have proven overly optimistic and subject to downward revisions. Given a backdrop of slowing global demand, still sliding commodity prices, not to mention rising stress in the US high-yield bond market, the Fed may only tighten policy once or twice in the coming year. Indeed, some argue that this week's tightening is all we're going to see. A one-and-done rate rise cycle is their view. So what does the bond market think? Well, this is where things look interesting. The bond market has long discounted the Fed's view of the future, and as of now thinks there'll be no rise until June next year. So all told, maybe the Fed shifts policy twice during 2016. And that's why the policy-sensitive US 2-year Treasury yield appears to have stalled around 1%. So what does this divergence between the Fed and markets really mean? It could be a slice of humble pie is brewing for traders or the Fed, and potentially a volatile 2016 for markets. A firmer US recovery next year means a faster pace of tightening. Now, the last time the bond market expected that kind of outlook was back here in mid-2009 and then early 2010, when indeed we were above 1% and rising towards 150. So if we do see 2-year yields approach that kind of area in the coming months, stand by for market fireworks. The current joy in equities will seem very short-sighted indeed.